Hello everyone, Joe here, making a video today to share with you guys some tips and one trick about stock trading specifically. These tips and trick are useful to those of you starting out from nothing or beginners, those starting from scratch. But I mean, it could be helpful to those of you who have been in the game a while as well, because it's still helpful to me. Um, Jumping right into it, tip number one, you have to understand what a stock is. A stock is a fractional ownership of a company. These companies divide themselves into these shares to allow themselves to be traded publicly so that people like you and I can invest in the success or lack thereof of their company. So, yeah, simply put, a stock is just a fractional ownership of a company. It's given a physical form so those of us can actually trade it and invest in it. So, tip number two, understanding indexes or market indices. So, as you can see on the screen here, the S&P 500, Dow Jones Industrial Average, and the NASDAQ Composite. So, these are the three most known ones you hear about on the news all the time, see in magazines, stuff like that. The main thing, we'll start with the Dow. The Dow Jones Industrial. I'm starting with this one because it's the most fascinating to me. It is the oldest of the three indexes. And the purpose of the indexes, first off, is to express to you what direction our economy is going, whether it's up or down, going up or down, trending up or down, so on and so forth. The Dow Jones Industrial Average was actually created in like 1882, I believe, by Charles Dow and Edward Jones, who actually owns the Edward Jones Company, where you could get mutual funds, stuff like that. And they also launched the Wall Street Journal in 1889, but that's beside the point. But yeah, the Dow Jones Industrial Average, created in 1882 by Charles Dow and Edward Jones. Um, it consists of 30 large publicly traded companies. They're all U.S. companies. These companies are such as, let's see, Exxon, IBM, Home Depot, Microsoft, Coca-Cola, and Cisco. So you can see how it's from all different sectors. It's 30 of the largest, though, to give an average on which way the economy was going. So that moves us to the S&P 500. So the S&P 500 is more modern than the Dow. I'm not sure exactly what year, but the whole point in the S&P 500 is it's 500 companies, as said in the name. It's weighted by market cap. That being said, these 500 of the highest market cap companies in the U.S. compile 80% of all of the United States market cap. Now, I'll explain why that's important in a minute. But some other key factors of the S&P 500 is they must be a U.S. company. The company must have at least $5.3 billion market cap and have 50% of their shares available for float. Now, what the float is every company has a certain amount of shares, but then you have shares outstanding, and then you have the float. What the float is the amount of shares that are actually available for the public to be traded. All the other shares are held privately or by like the board of investors, like that you just can't get your hands on them. So certain companies might have a lot of shares and not necessarily a lot of float because a lot of them are privately owned. So to be in the S&P 500, that allows a lot of the public to trade it because over 50% has to be float. And yeah, so the thing about the S&P 500 and the Dow is they're the larger market cap companies, so they don't factor in the smaller up and coming companies. So if the company was, if or not the company, if the economy was tanking based off of the market indices, you might have those random companies here or there that are actually doing well. So if you're looking to invest in a company that's new, up and coming, don't necessarily just go off the index. Be like, well, the S&P 500 is going down, Dow's down today, Nasdaq's down 2 points today, everything's down 2 points today. I'm not investing today, because that doesn't necessarily mean that the company's going to do bad. Like you can see here, this sector, technology sector on Finviz here, everything is green, but you have these little incipiencies right here. These little red pieces are two random companies in the sector that are going down, even though the technology sector is going up. And vice versa here with healthcare. Most of them red, a few here and there that are green, and this one who's bright green. So that's just to say, don't strictly go based off of the indices themselves. Let me get a drink of water. That leads us to the Nasdaq 100. Nasdaq 100 is a name given to a Nasdaq composite of 100 companies traded on the Nasdaq. The Nasdaq itself is an exchange. So the Nasdaq composite is also the name given for the index. The Nasdaq 100 or Nasdaq composite was founded in 1971. I know that. I know it's the second largest exchange by market cap, and it's just behind the NYSE, the New York Stock Exchange, which they're in the same city, which is crazy. The New York Stock Exchange, they're very similar, but the New York Stock Exchange, they have a few more stringent standards. The Nasdaq and the Dow, for instance, they're both indexes, but like I said, Nasdaq's also an exchange. The Dow and the S&P, you can't trade on the Dow and the S&P because they're not exchanges. And another thing about these indices or indexes is you can't trade them. They're just references to show you which direction the economy is going. However, there are things called ETFs, exchange traded funds, that you can find some that represent or track these indexes, and you can invest in those. That way you're investing in the overall economy instead of something more specific. So yeah, I mean, one last thing, the S&P 500, the Dow, and the Nasdaq, they share a lot of companies on each other's indexes. So like for instance, I said Exxon, IBM, Home Depot, Coca-Cola, Microsoft, and Cisco were all on the Dow. Well, they're pretty much all on the S&P 500 as well as the Nasdaq. So just because they're on one doesn't mean they're not on the other. So don't be like, well, I'm not investing in a Dow ETF because IBM's tanking and they're on the Dow, so I'll just invest in the S&P, because they're in the same thing. They're in both. So yeah. Tip 1, understand the stock. Tip 2, understand the indexes, what they are. So tip number 3, understanding the different types of trading. I broke it up personally into 4. I broke it up into scalping, day trading, swing trading, and long-term investing. Now, this is all preference and opinion. However, I describe scalping as you're quickly dipping in and out of a company that's being traded within a matter of minutes. This is often based off of chart patterns that are strictly high momentum, like supernova chart patterns that just boom out the roof. You're in and out real quick just to scalp enough of it. A day trade, you're in and out, pretty much making a quote round trip in one stock in that trade, that same trade day. And then you have swing trading, where you buy a stock and you sell it the next day. A lot of times I did this when I was under 25,000. When I was subject to the pattern day trader rule, I like to swing trade over the weekend, which is risky. I would buy a stock right before market close on a Friday, and then sell it in the morning on the hype Monday morning. But yeah, that's swing trading. It avoids using up one of your day trades. I find them very risky, but greatest potential for reward because you're not using up one of your day trades if that's your thing. And then the last thing, long-term investing. If you're holding a stock for like more than 5 days, I say it's no longer a swing trade. My opinion, that's long-term investing. You're investing in this company on a week-by-week basis at that point, um, and it's no longer swing trading. So, um, like I referenced with the PDT rule, the pattern day trader rule, with the pattern day trader rule, if you have under $25,000 available for trade, you're subject to the pattern day trader rule. Now, what that means is you only get 3 day trades every 5 business days. I don't exactly remember the repercussions if you violate it. Like if you make 4 day trades before the third one's processed, a lot of apps will like block you or prevent you from making the fourth. But if you somehow make the fourth in violation of the pattern day trade rule, I believe you get suspended from trading for like 90 days or something like that. But yeah, I wouldn't advise it. It just doesn't look good. It's not a good habit, and you don't want to get into a stock and not be able to get out for 3 months. Because if you're day trading it, chances are no one would really long term invest in it, and you're kind of stuck doing that for 3 months at that point. But yeah, that's understanding the different types of trading. Tip number 4: read earnings reports. I tell people this all the time. There's 2 routes you can take when you are about to trade stocks. I'd say route number 1 is understanding chart patterns, learning the chart patterns, cup and handle, supernovas, stuff like that. Just learn, how to identify what's coming next and what to avoid, what to look for, just stuff like that. And then there's the um, marketing aspect where you want to look at the ads, see what's getting hyped for pump and dump. There's actually a cool story real quick is with pump and dump. I actually made this email account once to filter out pump and dump ads of companies. A pump and dump is pretty much companies that are tanking or about to tank. They hype up their product like, oh, this stock's about to rise 10,000%, invest now, click here. When everybody's pretty much dumped their stock or they're about to dump their stock. So when all these people are like, oh yeah, they don't know much about the stock, so they just toss their money at it, and these stocks do go up, but everyone already invested in the company dips out because it's going to crash, and then how they pumped up that stock, and then the company cashed out. These people are stuck with these shares pretty much in single file line trying to get out and just lose all their money because the stock tanks. So there's a cool thing is it was like I was subscribing to all these newsletters and stuff to get notifications about these different pump and ups, and then I would like put short sell offers in to short the companies and then buy the cover later whenever they tanked. I don't know. It was fruitful for a little while there. Then it got to be too much work, honestly. Um, but yeah, reading the earnings reports is another thing in this marketing aspect. If you go to Nasdaq.com, there's a tab where you can look up the earnings reports, and you never want to look up an earnings report of a company that day or the next day. What I always do is I always look for companies, bigger companies, higher market cap companies that have earnings reports coming out within the next week to look at past reports, upcoming, just different forecasts, stuff like that. Because there's a saying that I heard, and it's held very true to me. You buy on hype and you sell on news. If news breaks of like a medication breakthrough or anything like that, it's probably already too late. You want to buy on the hype because everyone's looking forward to the outcome. And then the outcome comes, yeah, good or bad, the outcome's out. All the hype's dead. You know what I mean? The company, yeah, it still has value, but it's not as momentous as, you know, all the hype that drove it up to begin with. You know what I mean? It's going to fall down at least a little bit to find its happy medium. So you never want to invest in something that it's already at its peak of based off its hype and stuff. So yeah, learn how to read the different earnings reports. Look for the SEC filings. Just read different things. Look for missing numbers, expected growth or regression in the company, stuff like that could put you ahead of the game, especially if you're into the accounting aspect or marketing aspect. Next tip, you want to pick the right method for you. So, like I told you in the last video, in my first video, my method starting out was Robinhood combination with Ameritrade, combination with Finviz. Finviz screening, Robinhood trading, learning and charting Ameritrade. If you want to avoid commission fees, if you're like, I have $50, I want to invest my $50, I'd throw it in Robinhood. Because if you do Ameritrade, you're spending $6.95 to buy into the stock already, and then $6.95 to get out of the stock. You know what I mean? So you're already losing 14 out of that $50. So you already need your stock to climb 30% just to break even. So you know what I mean? If you have like $250,000, you might not want to do Ameritrade anymore. You might want a personal broker, just so that their focus is on you. Two heads better than one. You know what I mean? It's just finding the right method for you. Some people would like the Finviz stock screener that tests the ads and don't like the delay. Well, then you could become a premium subscriber, subscribe to it, and then you don't have to deal with that, or you don't have to deal with it at all and just not use it. So just find the right method for you, explore a little, learn what you want to do first so you actually know what to look for. But yeah, my next tip, you want to make rules. A big thing for me, my initial investment was $8,000 that I got from deployment money. I invested it all in stocks. I was doing pretty well. I got up to like, I think 11.2 thousand. I went all in on something, just greed. The greed got me, and I lost damn near it all. I was about to give up, but I remember one of my inspirations in the game pretty much said in one of his videos on YouTube, he said, make rules, never make the same mistake again, but never give up. So what I did was that year on my taxes, I did itemized deductions. I claimed up to like $3,000 in the capital losses, and then I reinvested it and came up with like a 10% rule, never investing more than 10% of my money that I had available for trade to prevent me from going all in. And from that point forward, every mistake I made, I came up with a rule. I analyzed what I did wrong and came up with a rule, and I never traded that stock again. That's mainly an out of spite thing. But yeah, you get the gist. Make rules. Don't give up. My next tip, do not trade what you're not willing to lose. Like I said, the 8,000 to begin with, and I lost it. It hurt. It hurt pretty bad. It was gut wrenching. But I was living in the dorm, single, 18 years old, brand new to the military. So I had no responsibilities. So it's not like the 8,000 had to go towards anything. I had no responsibilities. So that doesn't make it right, but it didn't make it a necessity for me either. So losing it, it was really whatever. It was a reality check, if anything. But yeah, don't trade what you're not willing to lose, because you want to trade scared and be able to jump out so that the greed doesn't get you, but at the same time, you want to be able to pull the trigger if you have to. If you see and trust your instincts, you don't want to be like, man, if this is the wrong move, I'm not going to be able to pay my mortgage. No, you shouldn't have invested that to begin with, if that's the case. So make your rules. Don't trade what you're not willing to lose. My next tip, for those of you more interested in day trading, scalping, swing trading, it's more than likely going to be with penny stocks. They have the most fluctuation, they're the most volatile. With penny stocks, assume the worst. Chances are, I'm not doing this to offend anybody, but this is the way I look at it. Doesn't mean it's the truth. I mean, it's partially the truth, but penny stocks, with these companies, you want to assume the worst. They're either failing or they're brand new. Companies, even successful companies today, when they started out, they had to go a couple years, most of them, before turning a dime in their favor. It takes a while for companies to gain their footing before they actually start making a profit. And a lot of companies that are failing to meet NASDAQ requirements, they fall off and they struggle to tread water, and they get pretty volatile. So always assume the worst with penny stocks. You never want to go all in on a penny stock. Never go Hail Mary on a penny stock. Just assume the worst, understand they're volatile, and respect the fact that they're volatile. Tip number 9, your taxes. Jesus. If you, pardon my language, if you make a lot of money, or even lose a lot of money, but especially if you make a lot of money, don't just start spending the money as you get it, spend the money as you get it, because when tax season rolls around and you file for like capital gains and it's like 42%, you're going to get nailed because you have none of that money left. Always wait to use your gains until tax season is over, or else you're going to get the hammer. Same thing with capital losses. If you lose a lot, you can, in a lot of states, you could claim up to like $30,000 in your capital losses. So even if you haven't gained anything, it's important to put it on your taxes so you could at least get a piece of it back. Taxes. Just always remember, Uncle Sam's going to come for a piece of the pie at the end of the year. Tip number 10, terminology and the phraseology of this type of stuff. Macroeconomics, microeconomics, reverse splits, floats, short selling, buying to cover, pattern day trade roll, SEC. I mean, need I go on? S&P 500, Dow, NASDAQ, all this stuff, all this terminology, this jargon in the financial realm. All this stuff, you have to understand it. Like I said, there's plenty of educational centers, be it on trading platforms or on YouTube itself or just Googling stuff. You have to understand this stuff before you know what's best for you. These right here are all different routes. Stocks, options, bonds, ETFs, futures, all that. It's all different routes you can take. You just have to find out what's right for you, but you'll never find that out unless you know what the hell they mean. So learn the terminologies, the definitions, phraseologies, all that stuff. Just a quick recap, the 10 tips I had. We know what a stock is now. We understand the 3 major indexes. We understand the different types of trading, that you have to read earnings reports. Pick the right method for you. You have to make your rules and do not trade what you're not willing to lose. Understand penny stocks, respect their volatility. Remember Uncle Sam at the end of the day, and then learn the terminology, phraseology, and definitions. The trick I have for you guys, the thing that really helped me gain confidence, were trading simulators. There's stock trading simulators all over the internet. If you type in, I think MarketWatch has one, so like Google MarketWatch and then stock simulator, you can trade real time, real prices, pretty much real. You do everything the real way, except you're given free money. They even have competitions like tournaments with, like, I think Verizon does one or Capital One does one, where, I mean, people have been doing it a while, but the winner gets a prize and stuff, and it's free. So why not take advantage of it? Just look into those stock simulators. That's pretty much all I got for you guys on this stock trading for beginners guide. slash tutorial, and I'll see you guys later. Bye.